All right, guys, welcome back to another episode of the Tim and Tim Show. Your favorite hosts, Tim and Tim. Surprise, surprise. Um, thing one and thing two over here. Hey, you got it right, actually. Oop, that
You
way.
didn't see the first one. I did
I
that.
was like, whoa,
Like,
that's pretty
yeah,
good, Tim. You
yeah.
got a
You
50-50 chance of getting that right.
you were looking down, and I was like, it would make sense because my window's right there, right there. There, I did it again. My window's right there. You would think I
Yeah.
would just point to the window because you're on that side of me.
My surfboard's over there.
Yeah, exactly. There's the
Oh, that's
floor,
funny.
right? Yeah.
Yeah.
So,
The floor.
yeah, exactly.
Oh
All
boy.
right.
Good times. All right. So, all right, today is July 8th, and what recently went into effect is the big beautiful bill that Republicans are shouting from the rooftops about that adds $3.4 trillion to our deficit. And I'm not sure how that really helps our economy, but somebody hopefully smarter than me has completely figured out how to fix our economy. And we are going to start talking about how we think this big, beautiful bill, along with the 100% bonus depreciation, is going to affect the real estate market. Because at the end of the day, Tim and I, we buy apartment complexes. We're real estate investors. We're paying attention to all of these things day in, day out to have an understanding of what the real estate market may or may not do and trying to prepare ourselves to act accordingly. Would
Yeah.
you agree or disagree?
Yeah.
Yeah,
I
agreed.
would
Agreed.
agree.
Yeah.
Yeah.
It's something that we pay a lot of attention to. I mean, we're talking about this today because Tim and I have these conversations between ourselves all the time. And now we're just going to put our opinions out there and our predictions. And maybe we're right, maybe we're wrong. We're not economists. We can be hopefully optimistic. However, we also can be pessimistic as well, and I think that is valuable because it gives us an even keel of what may or may not happen for our real estate deals in the
Yeah.
future. I mean, we're working on, gosh, 8 refinances in the next 5 months that are 6 months that are
Yeah.
due before the
Yeah.
end of the year. So we are paying close attention to a lot of these market movers, how the interest rates are being affected, the treasury bills, and everything. So we're just gonna get right into it, Tim. How do you feel about bonus depreciation coming back, and what is it going to do to the real estate market?
I'm like, I
All
don't
right,
know.
folks, that's it. Nice talk.
There's our show. I, you know, guys, this started because Vitali and I saw some, people talking like, yeah, like bonus appreciation's back, depreciation's back, and the real estate market's going to take off. And we're both kind of like talking to each other, and we're like, well, what do you think? And I'm like, I'm not so sure. And Vitali's like, me neither. Like, it's because there's like all these other things that play into it, and we go back to the last time we had 100% bonus depreciation, and there was this little thing going on at the time that I think we kind of forget, or we fail to acknowledge, like what it did for the real estate market, and that was like 4% debt. Like not only was it bonus depreciation, there's also this crazy interest rates going on.
Yes,
Right,
there's so many things that affect the real estate market.
right, and we do not have 4% debt right now.
Mm-mm.
Although, and I can't seem to get a read, man, because like in my head, I was like, I think the tariffs, I think the extra, oh God, what am I looking? The $3 trillion in national debt, additional debt
Deficit.
to,
Yeah.
thank you, deficit. And, that kind of stuff, the cost of goods, suppose this reset, all this other crap that's going on that would typically tell you interest rates are going to go up. Well, shit, I go out and read something over the weekend, I think. And some guy's talking about, I think rates are coming down. And I'm like, based on what? Like,
Based on
why?
what? Yeah.
Yeah. but he goes into this whole, and I wish I could find the article because I can't, my old age, I can't remember exactly what he said. But it was something like traditionally in markets such as, and he like named some things, and part of it was with the recession and some of the, jobs creation and all this other stuff. He was talking about rates typically come down. And I'm like, okay. But then you look at the other stuff, Tim, and it's like, rates typically are driven by treasuries, right? And, right now what we're seeing is the dollar's being devalued. There's less international money coming in buying US treasuries, which is causing treasury rates to go up,
Up.
which so I'm like, so are you telling me that lenders are reducing their spreads? Because if treasuries go up but interest rates drop, that just means lenders are taking a smaller spread, right? Am I thinking about that wrong? Because I mean, because
Entirely
typically the
correct.
yeah, because typically what lenders do is they go, it cost me 4% to borrow it. I'm going to lend it to you for 7, so I make 3. I mean, I'm simplifying it, folks. I fully understand that, but that's the gist, right?
Right.
And
And
so
lenders
I'm
are
like,
willing to take a smaller split above that. So really what's happening is like
yeah,
there's been so much volatility in the treasuries that the spreads are very wide because nobody knows what's going to happen.
right,
And the spreads meaning the spread above the treasury yield that the bank can
right,
borrow it at is what they're going
right,
to lend it to you, right? So in Tim's example, there's a 300 basis point or 3% spread above the treasury note. So 4 plus 3 is 7. So
right,
that shows there's a lot of uncertainty in the market of what's going to happen. If, for example, the spread was 100 basis points or 1% above the treasury bill, the lenders are pretty confident that the rates are stabilized and they're going to stay there for at least the duration of your loan, whether it be a 5 year or 10-year loan, right?
yeah,
That's really the long and the short of it. If you've never heard that, that's probably the most simple way to understand truthfully what's happening on the treasury yields. And the treasury yields are what drive the interest rates that commercial real estate investors borrow at. So
right,
like Tim mentioned, there's a number of things that are going into affecting the treasuries, and everyone's focusing on the Fed. The Fed does not have a direct impact or correlation to the treasury bills. And even if the Fed does reduce the rate, it does not mean that the treasury bill rates are going to go up or down. They don't move in correlation. Now,
right,
that does change your prime rate, right? So like if you have a HELOC, for example, or a line of credit that's lent at the prime rate is directly tied to your Fed rate, right? That Jerome Powell controls. And if there's a Fed rate reduction or increase, your
right,
savings accounts and prime rates and all that are directly impacted, right? I mean, I have, for example, Wealthfront is a high yield savings account that I have. The year over, like the basis points have gone down. The interest rate has gone down like 100 basis points or something like that. I
in the
was
last
collecting
year. Yeah,
over the last 12 months, I was collecting like 5% interest. Now it's down to 4, but I leave
yeah,
most of my money in that account just so that it's collecting money. But I pay attention to the Fed watch because it goes up and down and that
right,
directly impacts my savings. But what's happening with the treasuries is that with Moody degrading America's credit rating, that makes it so people would expect a higher rate of return because it's more risky, right?
right,
The only way to provide a higher rate of return for international investors is to increase the treasury bills. And therefore, we see this cycle of how interest rates on the treasury bills are tied to commercial real estate values because people are losing and gaining leverage and buying power as the treasury bills go up and down.
yeah, yeah, and
Bonus
then
depreciation in the big beautiful bill is only one piece of the real
right,
estate market. It's only one piece. Now,
yeah,
here's something to consider, and this, I mean, something to consider is that when we do a real estate deal, either Tim and I buy it ourselves, or or we syndicate it, or do it as a JV, or however we structure the deal, we never model in depreciation into the returns because it's not something that is a direct return on your investment. And in my opinion, and somebody can argue with me here, it's an ancillary benefit of investing in real estate is getting depreciation to offset your capital gains, whether it's on other real estate deals or if you're a real estate professional against your active income, blah, 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 blah. Right. But that is
yeah,
not a direct correlation of how the investment is performing and returning on your money. Right.
yeah,
Um, so, yes, bonus depreciation is great. Let me tell you, I bet you the Land Rover, Mercedes, Escalade, G Wagons, all the truck manufacturers, I bet you they're going to have a pretty good year because a lot of small business owners are going to want to get 100% bonus depreciation at the end of this year to buy a new
yeah.
vehicle, right? So that's back. Planes, planes are going to start selling a lot. I'm not
I think you just said something, man.
what
End of
End
this
of
year.
this year.
Yeah.
Yeah, I mean, it's
And
always like around Christmas time, you see all the temp tags.
and and guys, keep that in mind with the real estate piece, because here was one of my things. Like, I literally had a conversation with somebody about this weekend, and this was after I saw the Facebook post. Different person, but they were like, "Well, what do you think about the bonus depreciation?" I'm like, I have rarely had anybody show up to me in like June and tell
Yes.
me
I need
I'm looking
depreciation.
for I'm looking for depreciation, right? Right? They're like, I'm looking to invest some money. The bonus depreciation is a bonus, right?
Yeah.
It's literally a bonus, but I want my returns first. Now, that being said, come November, December, Tim and I have experienced folks coming up going, I'm going to owe a bill. Do you have anything with
Mhm,
that can give me some depreciation, right? And they're looking to invest more for depreciation at that moment because they're kind of like, I'm going to have to stroke a check for 150 grand. I'd rather put 150 grand into a deal and get, you know, at least it's an investment, but I want the depreciation, right? I
mhm,
want an offset, some sort of offset. That does happen. It doesn't happen all year long,
mm-mm.
right? And then the other thing too is, Tim's talking about those prime rates and savings accounts. Well, here's the problem with some of these deals, right? Like, hey guys, syndicators, we offer what, 7% prefs,
Mhm.
not guaranteed to be paid every quarter, month, or whatever. Well, that's hard to compete against a 4 and 5% high yield savings account, right?
Right.
Somebody's coming to you and they're going, I really want some cash flow, but I can get 4 and 5%
With
off of
no
that,
risk.
or
Right.
shit, I can go invest in Coca-Cola stock, right?
Mhm,
And get that guaranteed
mhm.
dividend payout with almost no risk, right? And it's like me pitching my 7% pref and a back end profit, right, for appreciation becomes a much harder sell.
Mhm.
So I think, but you go back to when we had 100% depreciation before
Mhm.
and 4% interest rates, and what were our savings accounts rates at that time? Like 1%,
2?
maybe,
Yeah, right.
maybe. I mean, the bank I used to keep all my savings at, man, my savings account rate went from like 2.5% down to like 0.75. I mean, it was
Yeah,
nuts,
right.
right? And so, yeah, now I got some of this cash sitting around and I'm out looking for a deal where I can get, 7%, right? An 8% annual return is great compared to the 0.75 I was getting. That's not the market we're in right now. So, I think bonus depreciation is awesome. I think it's great. I want it, right? I definitely want it. I don't think it's going to make the boom that we're looking for because again, we're kind of in a high interest rate market. People can go get, similar returns elsewhere.
Mhm.
And then, quite frankly, these high interest rates, man, it's just going to make it harder for some of these deals to cash flow.
Yeah.
Um,
Yeah,
so I
cash
don't,
flow is getting squeezed, with inflation still hovering just over
yeah,
2%. I just checked the CME Fed Watch tool, and there's a 95% probability that the rate will not change at the July 30th
there you
meeting.
go.
And there's like a 60% chance it might go down 25 basis points 6 weeks after that. So
Right.
you're looking at least 10 weeks before maybe any kind of movement. But again, I don't think it really impacts anything. I mean, maybe this is going to correlate to what you're saying, Tim, is like, okay, well, the prime rate might go down in 10 weeks as we approach the end of the year, right? Because you're in September now. Q4, we're right on the cusp of Q4 at that point. And people are like, well, I need depreciation. My savings account return's not really that high anymore. What options do I have? Now, that's not to say that the real estate market is going to go booming, exploding again. I just think that it
Mhm.
might be a little bit easier to raise some money on a deal, but deals are still going to be difficult to pencil with the changing environment of insurance and property taxes. Um,
Yeah.
you know, until something stabilizes in the insurance market and people can more predict what their insurance costs are going to be year over year, we haven't really seen a steady
No.
increase, right? I mean, it was 100% year over year for 2, 3 years. Just recently, we've had like maybe a 5% increase. That's good, or even an increase of like 2 or 3%, which are like, okay, maybe we've reached a level here now. But the other wild card there is what we were talking about earlier: tariffs. How are the tariffs going to affect insurance rates? Because insurance rates are directly tied to your replacement cost per square foot. As materials and labor go up, your cost per square foot to replace the building on your insurance goes up. Therefore, your insurance premium goes up, right? So who's to say that insurance isn't going to go up 10, 20% a year for the next 2 to 5 years? Who knows? Nobody knows, right? At this point. One thing I can say for sure, though, is Tim and I we do affordable housing, LIHTC. Everybody knows that. Some of the first people to be affected by this economic slowdown are our residents. So we're seeing an uptick in delinquency, an
Yep.
uptick in vacancy, an uptick in evictions. It's becoming very hard to operate affordable housing in today's market because of the economic tendencies. Now, property values could continue to go down with decreased income and increased expenses. Nobody really knows at this point. But one thing that could help is low interest rates, right? But that's not a
Yeah.
guarantee that real estate market will continue to go up. Maybe we just stay flat for the next 5 years. Who knows?
Yeah. The other thing too, man, like we haven't talked about is I think, and the interest rates comment kind of reminded me. I think we also have kind of like I think we're still going through some, I don't know, aftershocks or post traumatic stress or whatever from guys who bought things in 20, 21, 22, and they did so with this idea of low interest rates, right? And now they're
Mhm.
getting burned. They're getting burned
Yeah.
bad. And I think it's going to take a little while to get over that for some guys because as Tim and I talk around to a lot of brokers and stuff, the one thing we continue to hear from everybody is, guys, the buyer market has changed. Buyer sentiment has changed. The buyer
Yeah.
profile has changed significantly. And you don't see these guys going out there just like, I don't care. I love the location. I'm in love with the property. Let me
Whatever
just
it
pay.
costs. Yeah.
Yeah. You're not seeing that. You're also seeing a lot of guys that are kind of like, man, I just I just turned in 5 properties in the last year to the lender because I couldn't refinance them, and or they sold for a loss. So I think you got some guys that are got a little licking some wounds right now. It's going to take a little while to get over that.
Yeah. At least
So
another 2 years.
yeah, so you got that going on. We talked about the investor sentiment as well. Now that being said, are you not buying anything,
Oh,
man?
absolutely. We're totally buying stuff. Now's the
Yeah.
best time to be buying stuff.
And that's ultimately where, if you remember, that's ultimately where I went with that. I was like, hey, I don't think there's going to be this boom right now that you think there's going to be, but I think this is the best. I think it's a really good time to be buying.
Yep.
Is buy now, enjoy the bonus depreciation. Yeah, it's great. Let's all go get
Yeah.
that. But buy now, be very smart about the deals you buy, and 2, 3, 4 years when this boom does come back, or these guys are very interested in buying properties, be the guy holding the properties, right?
Hmm.
Um,
Yeah, because nothing is ever going to replace the macroeconomics of supply and demand, and where Tim and
right.
I buy our deals in the Carolinas. I mean, even in Texas and Florida and stuff like that. Well, maybe not Florida. There's some other stuff going on in Florida, but in a lot of the major Sunbelt areas where people were buying commercial assets, there was a huge supply that came online over the last 12 months. And oversupply, under demand has caused rents to soften. But what we know
Mhm.
from COVID and shortly thereafter, COVID, a couple of years after COVID, a lot of people didn't start building new
Right.
properties, right? And we live in markets where people continue to move to these markets. So the demand is absorbing the supply. And eventually there will come back into an over demand and an undersupply. And when you
Yep.
have that undersupply and a strong demand, that's when your rents start to go up again and property values increase because your NOI is going up. Now, that's one piece of the puzzle. The other side of the piece of the puzzle is again the interest rates. And once the interest rates drop and the demand is high again, now you have a 1-2 punch of my NOI is continuing to climb. I can sell the future value to a potential buyer. They can borrow money at a very low rate. There's not a lot of supply on the market to buy, so mine's the only option, and they have money to deploy because they want an additional benefit of bonus depreciation. Now
Right.
you have the three-peat of this is when the buyer when the cycle flips, becomes a seller's market instead of a buyer's market, and you want to be the person holding those real estate deals at the end of the day when that happens.
Yeah.
When
Yeah.
that happens, I don't know exactly, but my prediction is sometime between 2028 and 2030.
Yeah, and guys, it will happen. I mean, historically, this is a cycle that has repeated itself over and over and over and over and over and over again,
Right.
time and time again. I mean, this cycle repeats all the time. And hey, if you're in a position right now to acquire that stuff and be ready when that cycle in 28 to 30, like Vitaly said, happens, then this is the time you do it. You buy it and you sit and you wait for that cycle to come around.
Right.
Um,
So
it
we're
will
refining.
it will
Yeah, it
happen.
will. Right.
Yeah,
Absolutely, it will. I mean, look at 2008, crash, 2009, 2010, crash, stayed low. And then what was it, 2012? From then on out, it would just continue to rise back.
yeah,
Right.
yeah. Steady climb, and then like 21 through 22, it just like hockey stick. It was crazy.
I don't think
Um,
we'll ever see something like that again. I mean, I don't know what would ever cause the prime rate to go, the Fed rate to go to zero again.
yeah, I don't. I won't say ever. I don't know that it'll ever be the same factors.
Mhm.
Yeah,
The
I don't know
probability, I
because
think, is low.
yeah, I don't know, man. I don't know what's out there lurking that we've never seen before, right?
Mhm.
It's
Yeah,
gonna
what's the next
pop up.
black swan bat soup event?
Who knows? Bat soup. Yeah, who knows? Who knows?
Uh,
It, all I know is like there's like we talk about though, man. Like there's some fundamentals. Just
yeah,
stick to those, and
right, right,
when it's a buyer's market, be a buyer.
yeah,
Because at some point it's a seller's market, and you want to be a seller.
right. Yeah,
Can't
I
be a
mean,
seller if you were never a buyer, right?
yeah, that's true, right? I mean, the brokers understand that. They're like, "Oh,
Yeah,
well, they build relationships with buyers because buyers eventually become sellers." And
sellers,
they wanna see that, that repeat business with trusted clients
right?
over and over and over again. And the only way to get there is to buy something first. Is it going to be your best deal? Maybe not, but you got to get off the sidelines and got to do something, right? Taking action is better than no action at all.
Yeah,
Um, and that was another part of a different post was, it's like people waiting for the rates to change or waiting for this to change. And I know, man, it sounds like a broken record. Everyone's always talked about this. I think no matter what, you're always going to have that excuse in any real estate market of or
yeah,
cycle of, oh, I'm waiting for rates to go down so I can buy again, and then rates go down and I'm waiting for prices to come down when it's more affordable. It's like you're never going to have
yeah,
the perfect opportunity to buy, and honestly, I don't even really have good advice on how to work around that, except for just continue to make offers at what makes sense for you with what you have
right.
available today, and eventually somebody's going to be like, you know what? I got to sell this and this is the best offer I got. So I'm going to do it.
Yeah, I heard a good sentiment the other day. We were all talking. I was talking to a friend of mine who was selling his house, and he was pissed about giving up his 2.9% interest rate.
Yeah.
And he was like, "Man, it's really hard to give that up." And I was talking, I was like, "Yeah, I'm at 2.85 and I love it, and blah 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 blah." And he's like, "Yeah, I did 2.9, and then like a couple weeks later, a friend of mine got like 2.7 or something like that." And he's like, "Man, I wish I would have held out for 2.7." And I'm like, "But when they were 7%, weren't you really happy that you signed at 2.9?"
Yeah.
And it's
Right.
like, don't be that guy that's always like, "I'm waiting for this."
I could do
They
better. I could do better.
because I can promise you, you're sitting here at 7, and when it hits 4, you're going to be like, "I think it's going to hit 3.3," and it's like,
Right.
I'm going to wait for that. Yeah. So don't
Tim,
be that
let
guy.
me see one of those crystal balls that you got back there because it's got all the answers to everything.
No, I collect them. I keep them in my closet. I don't let anybody else have them. Um,
Yeah.
oh yeah,
Anyways,
my
yeah.
closet.
So, where everything goes with the bonus depreciation. Actually, one thing I'm not certain on is I know that it's signed into law, but I think it expires again in 2029. Is that correct?
I think I saw 2030, but I'm not sure.
So
Um,
that kind of further supports my 2028 to 2030 timeframe because
People are going
as
to
the
want
bonus
it.
depreciation 100% goes away, I can guarantee you some people are going to be looking at that and knowing that we're on the coming out of a down cycle and going into an up cycle. I guarantee you
Yeah.
that when that starts to come to an end, people are going to be buying like crazy in order to place money if it hasn't already started.
Yeah.
But it's just
It's
another cap in the feather in the cap towards like the argument.
Yeah, it's going to be interesting to see what comes out of this bill. I mean, we all know what bonus appreciation can do for us. We know what the benefits are. There's a lot of unknown in this thing, like Tim and I are talking about. Like, who knows what's going to happen with the deficit, and hell, you even see people like arguing about, is it really 3 trillion? Because I think there's this offset or business and all this other stuff, and I'm like, I don't know.
Who
I mean,
knows? Yeah.
who knows? Um, and then
But,
it, and then it
for some people, it's also a good time to loss harvest, right?
yeah, yeah.
If you start adding up depreciation and look, one thing that people don't consider is we're coming out of a bonus depreciation cycle. And if you claimed 100% or 80% bonus depreciation and you're going to sell your property at a loss, you still have to pay depreciation recapture.
Back, yeah,
So it might be a good thing for you to dump one of your down deals, recycle your money and put it into a new deal and get new 100% bonus depreciation in the
offset.
same year to offset the
Yep.
recapture that you would owe, right? And it's like, oh, geez, like, I know our CPA is doing a webinar, I think at noon today, talking about the big beautiful bill and how it's going to impact real estate investors and everybody that all of his clients essentially. And there's a huge tax play here, understanding how to loss harvest and stack bonus depreciation. And then, like, if you're going to do something like that, like, you have to be strategic about it for sure.
Yeah. I will say this. I love the upsells, right? Because
Oh yeah.
it's funny, guys, I'm on LinkedIn a lot. And there's a guy out there I have not seen that much on LinkedIn in the last year and a half. And when this bill passed, all of a sudden, man, he's like all over the place. And guess what he does?
Oh, he's a
Yeah.
CPA, tax return,
No,
right?
he does
Bonus
he does
cost segregations.
he's a cost seg guy.
Oh yeah, man, they're gonna be busy. They're gonna love that.
Oh man, the next day, like he's all over LinkedIn again. And I'm
Let
like,
me
he's
educate
back.
you why cost segregations are so important. It's like that on Twitter right now too. It's like
Yeah, yeah,
everyone's
yeah.
posting on X about the big beautiful bill and their interpretations of it and what services they provide to help you do this. And hey, you know what? I applaud the entrepreneurial spirit,
Oh yeah,
but
for
man,
sure.
it can get exhausting because it's the same stuff over and over and over and over again.
Yeah. So,
But yeah, cost
I,
seg guys are going to be busy this year. But you know what? It's funny. I think about the guy that bought my property in South Carolina. He closed on like January 5th or something like that. It doesn't qualify for 100% bonus because it only goes into effect on, I think, on January 19th, 2025. So,
oh man.
yeah, I know. I know.
Oh,
It's
it goes
not
back
even
to
January 1.
dude. Oh man, it goes back to the inauguration. Is that?
Yes. Yeah, yeah,
Oh,
exactly. I thought about that in the back of my head. I was like, "Oh, damn. Did we sell anything I think we sold another property in early January as well. I can't remember. Was it Hardin, maybe?
you may be
Or was
right.
that February?
I don't
I
remember.
can't remember. We sold a couple properties in January, but that's really got a bite,
Ah,
man. Like, oh, that the deck didn't fall your way on that one.
I, I had missed the retro part. I'd missed the
Yeah.
date on that.
Yeah,
Wow.
January 19th. We didn't buy anything earlier this year, but we sold a couple things. So,
Yeah,
oops.
yeah.
But
We,
all right, guys, that's all we got for today. Appreciate everyone joining. Hope you got some insights from our insights. I'm curious to know what you guys think. If you have any opinions or you want to argue with us about it a little bit, drop a comment below and we'll respond on Facebook and LinkedIn. And we also have a YouTube channel where things are posted as well. So I'm curious to hear your thoughts and appreciate everybody joining. And we'll see you. Actually, you will see me next week. You will not see Tim Vest next week because he got approved PTO somehow. So he is not going to be here next week, but I will see you guys next week. Peace.
see you guys.